beginning of the year, we felt that the multiples on, say, the earnings of the companies were quite elevated. We said we did not forecast any more multiple expansion. In other words, we felt the market was fully priced. And we also said that the return for the year would mostly come from the dividends from the income stream that you are generating. If you look today, that outlook might have been a little bit too optimistic in retrospect. We've seen multiples actually decline at the margin, and certainly we've seen some individual segments of the market suffer quite a bit in light of concerns over China slowing down and over the Federal Reserve increasing rates, and that has had an impact on certain segments of the market for sure. Within the TDI context, we seek for companies that have very strong income streams, companies that have the ability to maintain that income stream and better yet grow it over time. And from that perspective, we have not been disappointed. We've been able to capitalize on attractive income streams in various income components and subsectors of the equity income spectrum, and in many cases we've seen our companies continue to increase their distributions, their dividends. So from that perspective, we have essentially accomplished what the strategy set out to do. What has been disappointing or challenging this year, at least so far, has been the decline in the prices of the securities, and these securities, the income securities, are essentially in the area of the market that has been the weakest. It also sets up as an opportunity because many of the companies that we invest in continue to exhibit very sound balance sheets, management teams that are in the know of how to navigate through challenging environments. Even though the strategy has been in an area that is challenged, the conviction of the strategy has not changed, and at the margin, on a go-forward basis, we're seeing some attractive opportunities here. So if you look at the TDI current positioning of the portfolio, we're roughly at 20% in energy MLPs. We're about at 15% in REITs, and the remainder is in common stocks and other equity-like securities. Of that is about 15% in mandatory converts, which give you a high income stream for typically a 3-year period of time, which gives you also a little bit of downside protection, as that income stream is not only elevated but quite high up in the capital structure, meaning that it is fairly secure that you're going to get that income stream. So we have about 15% in these mandatory converts. If you look at alternative asset managers exposure, that's around 12%, and the rest is in mostly very high quality common stocks with strong dividend profiles. So that's the mix at the moment. It's an eclectic mix. We're benefiting from different themes, some long-term themes, some a little bit shorter-term themes. But all in all, Mark and I have quite a bit of conviction in the current positioning of the portfolio, and we have not made drastic changes to that, as we continue to like all these asset classes and the way they interact with each other in the portfolio. The outlook today is more positive than at the beginning of the year, mostly a result of security prices declining, in some cases quite substantially, whereas the fundamental picture has not really deteriorated all that much. We're still in an environment where corporate bonds don't yield all that much, and treasuries don't yield all that much, and meanwhile the demand for income continues to increase as more and more baby boomers are actually going into retirement and looking to recreate a paycheck of sorts, or at least income streams from various sources. And that's very challenging if you just look at the bond market alone. You almost have to embrace a little bit on the equity side, even in retirement, on these high-quality dividend-paying stocks and other income-producing securities. So on the one hand, the demand remains very elevated for income, and I anticipate that demand to be there for quite a while. And on the other hand, the supply can indeed come from these equity securities, and given what prices have done in general, with the volatility that we've experienced, that sets itself up as quite a good opportunity going forward.